Hey guys, welcome back to the Capital Mindset Show. So today we're going to be talking about a stock that I got a lot of questions on that's actually added to the portfolio, and that is Thor Industries. So I got a lot of questions on Thor Industries, like, okay, why do you own Thor Industries? Why are you buying Thor Industries? So this hopefully serves as a little bit of an analysis as to why, and might seem underwhelming a little bit, but I hope you guys enjoy the video. All right. So on that note, let's begin with the price action of Thor Industries and a little bit of an explanation about what Thor Industries is, what they do, and then we'll kind of get into like the valuation and a little bit of the thought process as to why they're added to the portfolio. Okay. So first, let's begin with, again, the price action. So they've actually been punished quite drastically over the 1 year, right? Down about 40%. And I think rightfully so, because here's the thing. Thor Industries is definitely a cyclical business. And let me just say straight off the bat, I would not be surprised if this business actually does downtrend into the 50s and 60s, right? I won't be surprised. Okay. So what basically happened, and the context is very important. They actually were in a downtrend over here. And I've actually had a history with Thor Industries because I guess we need even more context. This business is actually a really good business and better than what people think. And actually, the only main competitor Thor Industries has is actually a subsidiary of Berkshire Hathaway that, again, Berkshire Hathaway had purchased and is involved in this industry because at the end of the day, it actually is pretty good business. It's a very niche business, not many competitors. Again, it's pretty much just Thor Industries and Berkshire Hathaway who dominate this industry globally, right? And then Thor Industries had recently purchased its European competitor. So basically now Thor Industries is by far the more dominant player in this industry. And again, it's a very small category. Look, like we're looking at the largest player here and it's about a $4 billion market cap. It is a small industry. Okay. So we're not going to see, massive expansion. Of course, some might say, oh, well, there's a lot of opportunity. A lot of new people got introduced to the RV space. Yeah. Well, we'll throw that all to the side. Right now, what we're focusing on is a lot of demand was pulled forward, perhaps, right? And then that's the fear going forward into the future, that because of that, this upper price point of about $145, it wasn't justified or sustainable, because as people stop, having to go on these unique vacations on these RVs or trailers, they won't purchase as many, right? And a lot of demand again was pulled forward. And we actually see the cyclicality reflected again in the stock price, right? In downtrends and down markets, when the economy is doing bad, obviously the sales for these vehicles are going to be less and less and less, right? And again, we've been talking about the concerns as how higher energy prices could squeeze out the consumer in the developed markets, and spending might be geared towards or more focused towards the actual necessities rather than these recreational uses, right? And these are recreational vehicles at the end of the day. Right? They're not even like utility vehicles, such as like, your car to go to work. You don't really have to get an RV, right? So anyways, we're disregarding that for a second. I would not be surprised if this actually corrects further, but for me, I'm just going to be accumulating throughout that, right? And so I think that the market might, if it corrects, it's going to overcorrect, and then I'll just be there to buy up the shares, right? And I think this is one of the best run companies in this industry. So why was I saying that in the beginning? It makes it sound like I'm not really bullish at all in this business, is because I want to be as unbiased as possible and actually highlight to you guys, my audience, that even though it appears as though it is cheap, there is a reason why it does, right? There's a reason why it looks so cheap. It's because the performance more recently is indicative or reflective of a very unique situation, which was COVID-19 and the pandemic, and people having to be creative with how they take certain vacations. And there was Thor Industries right there and all of their different products. That was perfect place, perfect time for that. Okay. So let's go over to the investor presentation and kind of see the sales pitch of this business and see if anything really excites us. All right. So we'll look at this together. I haven't even seen this yet, but all right. So net sales about 3.88 billion, an increase of 42%. So again, we're getting that. And this is, by the way, a quarter. So it's not the full year. It's just a quarter. So again, it's a 42% increase in sales, right? Is that sustainable? I don't think so. Personally, I don't think so, right? And I'm investing in this business. I might sound a little bit pessimistic, but I don't think it's sustainable. Gross profit margin of 17.4%. That's up 2%, 2.2%, right? That's pretty incredible right there, right? And then diluted EPS of about an increase of 100%, right? So let's remove that increase. Let's say it was only It wasn't. Like, let's normalize it, right? So then that's a PE of about 10, 8, right? It doesn't look as expensive, or sorry, as cheap there. It looks really cheap now because they had a massive growth, and the market's not giving it to them, right? It's not saying, well, you deserve a higher multiple now, or you deserve to trade higher. And in fact, it's actually trading lower because the market is telling you that they are pricing in a slowdown. Now, to what degree will that slowdown be? Now, that becomes the interesting question that you have to answer, right, before you get involved in something like this. Okay, well, the backlog, we do see that it is $17.73 billion, an increase of 63%. So we are seeing robust demand from the industry. We're seeing robust demand from consumers. Will this continue? Very important. Take a look at this inventory, right? So North American independent dealer inventory of their products, it has been downtrending. And again, this is the nature of a cyclical business. Now, we have not reached inventory levels of 2018. I want to point out to you guys, again, look at 2018 when inventory levels were high. Inventory levels were high, downtrend down because they get bought up, right? And then you have that cyclical nature. It overreacts, and then you have upside right there. And it was right moment, right time. So then again, when inventories were down in 2020 and 2021, we are seeing again, of course, order backlog go up. And this was being priced in because the market is a future pricing mechanism, right? So this information is known. All right. So again, we might just overreact. Okay. So I hope that kind of makes sense. Any questions on that stuff, go ahead and leave it down in the comments below. All right, net sales, we are seeing, again, the increase, gross profit margin increase, and then backlog increase. Okay, so 10 billion in backlog is the, I think the estimate for 2022. Okay, North American towable segment, they're just breaking down each sector, by the way. So, and then again, North American motorized segment, again, I'll let you guys kind of go through that. And then the European segment, the reason why this is separate is because they're different markets, different need cases, and they bought out their European competitor a while back. I think it's been over 2 years now. All right, so here's some examples of their brands that you guys may or may not be familiar with, but you guys can look through them, pause the video here, and take a look, right? And if you're in the European markets, you might be familiar with some of these as well. Okay, so the United States still makes the majority of their sales, and that makes sense. United States geography kind of allows for this thing. Europe is a little bit, not that it's limiting, but it's a little bit more difficult than the United States. United States is a very expansive. They have a bunch of undeveloped land in comparison, which is, adds to all these other advantages for the United States geographically that, it's not for this video, but for the most part, for this business, it makes sense that the majority of sales are coming from the United States. At the end of the day, it is an American company. Even though they did purchase their European counterpart, that European counterpart also sold into the United States. So, overlapping businesses. And how Thor Industries kind of works is in a decentralized manner. So they buy up these businesses and kind of let the managers kind of duke it out, which I really like. I like that model because that essentially allows it so that you don't have as much micromanagement from the top, and you kind of allow human creativity to kind of grow each individual brand, right? So you have, this person's in charge of that brand, this person's in charge of that brand. In some instances, they might be competing, and that competition drives innovation. And then overall, that helps the overall industry, or not the industry, but the company, which is in this case, is Thor Industries. So taking a look at the overview, this is important to kind of gauge what management is trying to tell us about the overall business going forward. So consumer confidence versus retail registrations. So consumer confidence, they're kind of showing you here that there is a high correlation between consumer confidence and the purchase of these vehicles. If a massive downtrend occurs, like for example, 2007, 2008, 2009 in consumer confidence, then the sales or the future sales of this business will come down, right? That's a little bit of a cautionary note, right? It sounds like I'm being bearish on this, but I'm invested in it now. But anyways, okay, we don't need to see that, but that's basically the compound annual growth rate. Capital management. Okay, so this is them showing their cash flow. So net cash from operating activities and capital expenditures. So their cash flows are rising, right? So we do see that there is like a small drop here from 2020 to 2021, but that's okay. It's still much higher than previous years. And again, we are seeing an improving business. I think they just got a massive, by the way, insider buyer, right? Okay, so they are actually trying to highlight their dividend. This is a new policy to return capital to shareholders, and we'll actually see that the dividend is very, very sustainable. Of course, we can even make it a little bit more conservative because maybe the income isn't necessarily as accurate. Maybe, again, they pulled forward a lot of demand. So if going forward, it's going to be less. But even then, it's still very conservative. Okay, so that kind of sums it up. And let's actually go over here to the model and plug in Thor Industries. So right off the bat, I think that the model is going to think that Thor Industries, is extremely cheap. And we do see the analysts have a 53% upside target on it, PE of 6.76 and a price to free cash flow of 11.21. So on a cash flow basis, we're a little bit more accurate in that regard. They've grown on average about 24.43% over the past couple of years. I do think that they might slow down that dilution rate. So they normally have been diluting by about 1.3%. And it does make a little bit sense to do that. Now, we do see that dividend yield of 2%, dividend payout of 22.83%. So let's actually increase our margin of safety to begin with and kind of map out what we do think the business will perform over the long periods of time. So I think, for example, 10% and 3% is fairly reasonable, even though that 10%, some people might think that's very conservative. I just want to be conservative in order to kind of plan out the eventual, slowdown. And maybe we're mapping out that some of that demand was pulled forward, and going forward, we might see an increase, but not as much as before. So I'll say this right now, around the 5% growth and 3% growth is where I'd be very comfortable with accumulating a lot of shares. But even here, because I do think that we're at enough of a good enough buy price for me to start building a position, but not something for me to like be super excited about. So 8% is what we're basically pricing in for. And let's actually remove this right here. So we're still, about 8%. And let's change this. So I guess 6%. So 6%, between 10 and 3%. Again, some of you might think I'm being too conservative here, but I'm doing that on purpose. Let's actually take a look at the ratios to kind of get an idea of the health of this business. It looks fairly healthy in a liquidity basis. Current ratios above 1, well enough above 1. And then solvency ratios are very good, actually coming down since 2019, so getting better. And they had no debt in 2018. They raised some debt, but then it's actually coming down. And so taking a look at the gross profit margin, it's pretty much remained range bound. So this gives me a little bit better clarity as to where they are in the business, because we know that 2018, there was a glut of supply. 2016 was the buildup. And so we're probably in the buildup phase, and then we're going to get into the glut phase at some point in the future. Operating margins are fairly range bound as well. Net profit margins are fairly range bound as well. ROA, ROE, fairly range bound as well. ROIC is kind of all over the place, right? We do see some years it's really high, some years it's really low. I do think they're on a lower bound, and then we actually might see a higher bound soon. Similar to how, again, we see the buildup from here to around 2018 and then right back down. Okay. Earnings quality. Let's see here. Earnings quality is pretty good, actually, for the most part. And then we are seeing a downtrend right here. It's actually kind of like a 2014 scenario where we are right now in 2021. So this probably will improve as the backlog gets executed. So again, with this business, by the nature of how they accept orders and payments and all that, that's fairly normal. All right. So I think that will conclude more or less my thoughts on this. Again, you guys can check out the portfolio to see any changes at any point. And I'll be adding to this position, just accumulating here and there. My excitement for this business will increase as the price comes down. And if it continues to trend up, I will be, fairly disappointed, but not super disappointed, because it wasn't even planned to become like a core holding or anything like that. I'm more excited about, Netflix and other businesses like that. So, really the one that will affect me the most is Alphabet. If something happens to Alphabet. So on that note, guys, I hope you guys have a great one. I'll see you guys in the next video. Bye.